Frank, as an ex-banker, I'd like to consult you on the topic of housing affordability. Let's go through the official bank method of determining whether a client can afford a certain level of mortgage. How does that work?
Well, the banks use two debt service ratios. One is around 38% and the other one is around 48%. The 38% figure includes only the expenses relating to the house and the mortgage and the heating, etc., the monthly payments. The 48% is the total debt service ratio, which includes other debts. So, for example, credit cards, car loans, etc.
And we're talking about before tax income there.
Pre-tax income.
Okay, so that's the official way. That's how the bank decides, will this customer default on the loan or not? But the question for the home buyer is, how comfortable will I be making mortgage payments at this level? How do you suggest people approach this doing their own analysis?
Well, I think it's very simple. They're already paying, if they're up to the point where they're paying 48% of pre-tax income, and they're paying income taxes of approximately 30 or 35%, that's not leaving you a lot for your discretionary spending and especially all of the expenses that a house brings about.
Okay, what about rising interest rates? Should you leave a little extra room in your affordability to accommodate having to pay higher interest rates when you renew your mortgage down the road?
Well, one easy way of being able to counteract that is just to, at the outset, add an extra payments. So in other words, don't just put in the minimal payment of the mortgage, but add a couple of $100 extra per month. And what that would do is that sort of insulates you when the rates do go up.
Okay, it's almost as if you're paying a higher rate to begin with, and so when it happens, you're already covered.
Right. Another strategy that's worked in the past is to choose the variable rate mortgage, but increase the payments. And so therefore, if you're doing that over a couple of years when the rates go up, you have already insulated yourself, and at that time, you may peg in at the fixed rate.
Okay, thanks, Frank.